Happy Monday. It's great to have everyone here. My name's Roberto with Latino Tax Pro, and I'm here today with Jose Rojas, one of our enrolled agents. And today we're going to be talking about another tax tip that Mr. Jose has for us. So go ahead, Jose. What are we going to talk about today?
So today we're going to be concentrating more on depreciation for rental properties and why it's so important today. But I want to thank everybody for joining us today. Hopefully, everybody had a happy Father's Day, and we want to say happy Father's Day to all the fathers
Yeah,
that might be watching over here. So, and Juneteenth, right? I think that's the new
Juneteenth.
holiday
Yeah,
as
yeah.
well. So, I just want to start off by letting you know I still see a lot of people coming in with reporting no depreciation for the rental properties, especially since they think it's optional, which is not optional. So, I'm going to be going over that one and why it's so important on that one, and maybe why you why people might think they shouldn't have to report it. So, just give you back a little bit of history on depreciation. Normally, you get depreciation for rental properties when you purchase a home, or maybe you have land and you built some property on that rental property. So, people in the past, and I think it's been forever, we're able to get deductions for those rental properties, and we get a if there's a negative as far as a profit and loss. Now, what I've been seeing a lot lately is people not reporting depreciation, thinking it's just optional because they plan on selling their rental properties in the future and they just want to put what they purchased it for and what they sold it for, but that's not going to be the case. Remember, when depreciation is getting or property is getting sold, they want to know depreciation. They call it allow allowed or allowable, meaning you either took it or you didn't, but we still want to report that depreciation. I have been seeing some people when we do report some sales for those rental properties that they haven't been depreciating. We can only go back for 3 years to get them refunds because it was actually less income that they received for those tax years. So we want to make sure it's really important for everybody when they put into the rental properties or you purchase a rental property that they put depreciation the day they rented the property. A lot of people think, oh, it's the day when they purchase a property. No, that's not going to be the case. It's actually going to be the date when you place it in service. And it's very, very key that you know when you place it in service because it might not be when the tenants moved into the property. It's actually going to be when you place the property for advertisement for rental property. So that's going to be the place of service. So it's going to be the date of service is going to be when you place it in service for renting and it's available. And then that's when you're going to be able to start that depreciation going forward. Now, if you end up adding or needing to add it now and you didn't take it in the past, you're going to end up having to start it on that start date. And if you're going to want to take those deductions the past 3 years, you can. You just have to amend those returns to show that depreciation through those past years. Now, a lot of people say, well, what's the point of having depreciation? Because I don't even get credit for those deductions because the max income you can have goes from 110 to 150, then you don't get any deductions at all. I see a lot of joint filers that don't get any deductions for rental properties. And they said, why do you even put a depreciation if I don't get those deductions? Well, what happens when you don't get those deductions, they roll over every single year. So when you do sell your property, then you get the full those get those take advantage of those deductions as well. So it's very, very important that you do put those deductions in there. And if you do have losses, and don't be scared to carry those losses forward or the following year. You still do get credit for it when you sell a property or um, when you end up selling the property later on in the future. Now, there's going to be some things when to keep in mind when you do sell a property on rental properties. You do have that capital gains. Most of the time, it's going to be long-term capital gains. Short-term capital gains is going to be that depreciation portion. So there's going to be some short-term capital gains and then long-term capital gains. You want to make sure if you have the software that it does it for you. I know in the past, in the 80s, people have been doing it by hand. I don't know how they do it. My Mr. Lopez here, he says that we used to put the years of how that or how long a life that depreciation is going to be. So why do you want to put depreciation? Well, depreciation is going to be the life of the property. The life of the property is going to be depending upon the loan of the property. So sometimes they always get it 30 years, and that's fine. If you get commercial property, you always get loans for like 39 years or 40 years and stuff like that. Most of the time for real estate property, personal property is 27 and a half years. And then you take that depreciation and then you take it out throughout the years. Now, it is a straight line depreciation. So it's going to be literally the same amount almost every single year you take that depreciation. So if you know how much the depreciation is going to be for 1 year, you know how much it's going to be for the next year. So that's why it's kind of nice that you know, like, hey, deduction is going to be around the same for depreciation. It's going to be, and that's really a key when you're trying to uh, find out or get an estimate on what you're going to look at for next year when you raise the rent, or you do some big projects and you want to see how much more of a deduction you're going to have for next year. You don't have to guess on how much depreciation you're going to have. So that's kind of nice on the straight line depreciation. And that's how that's usually a nice way of looking at it for in the future. Um, when people do sell properties, I always see the big old surprise saying, "Oh my gosh, I owe so much." A lot of times I get clients that come to me or talk to me later and said, "Why didn't you tell me about the 1031 exchange, right? So I didn't have to pay those capital gains." Well, they should. If you talk to your clients when you're doing the tax returns or interview the clients, you got to ask them what are they going to do when they in the future with the rental properties. Are they going to pass it down? Maybe put it into a trust so they can get some stepped up basis when the children take it. It's some of those things that you want to know. You want to find out. Or maybe they do look at that as like maybe part of the retirement plans. Once they sell it, they want to put in the savings and then use that as part of the cash for a retirement plan that they have. But you got to let them know, hey, if you're going to sell it, you are going to have some capital gains. You're going to pay back that depreciation. Whether you took it or not, you're going to end up having to pay that back. So it's very, very important that you just understand allowed or allowable, meaning you're going to have to report that depreciation whether you took it or not on rental properties. All right. Hopefully, you guys understand that one. I do still get a lot from even other tax professionals that don't report that depreciation. Now, I understand there might not be an issue when you don't report depreciation because you might have purchased a land and the land is, of course, is not depreciable. But the trailer that you have on there or the mobile home that you put on there would be depreciable. So you got to make sure that you have that in there when you have it or when you're reporting on the Schedule E. Like I said, I still get some clients that are coming in from other tax offices, and we're not sure why they're getting more reduction they did this year than last year. And I explained to them it's because we put depreciation, and I noticed that you didn't have depreciation the previous year. So it's very, very important that you guys put it regardless for rental properties because it's very, very important on that one. All right. Roberto, is any questions? If you guys have any questions, I'll be happy to answer it. Um, Basically, coming from my experience, and I'm pretty sure some other professionals that might be watching it, you do still come across some of these clients that come in and they just do not report that depreciation. So
Mhm.
remember, when you start reporting it, it's going to be the date you place it in service. So it's going to be when it's available for rent. When you place that first ad, that's going to be the start date for that depreciation, not the purchase date, and not when the tenants necessarily move in and you or collect the first part of your rent. It's going to be when it was available. All right.
Yeah, yeah, it's all very good information. Thank you, Jose. Yeah,
Yeah.
this year I didn't really have to do a lot of depreciation, just one or three clients, and it was to me personally, since I just started preparing taxes, I found it very confusing.
Yeah.
But I guess the more we do, the more we learn about it, the more easier it's gonna become.
Yep.
And one thing I do have in question is that what is when it comes to like the section 179 and the bonus depreciation, what are the benefits or like the consequences of using either or?
Yeah. So when you do, and it's going to be part of like construction, maybe you're doing some remodeling in the house. You're able to take a 179 deduction, or sometimes they might qualify for bonus depreciation. So the difference between one is a bonus depreciation gives you 50%, when a 179 gives you 100%. Now, in some cases, if basically if you're self-employed or you're an individual on a Schedule C, when you take that 179 deduction, you can only take it to the amount where it drops below zero. And I mean by zero is your net income. So you can't really take a negative on that one. So sometimes it might be best just to take that normal depreciation that you take. Now, the 50%, I don't know if the software is doing it wrong, but I've noticed that it does go below zero. So when you do take a 50% deduction, so I don't suggest that you go negative or below, but it does sometimes qualify you for a better deduction or bigger gains for deductions. Now you got to be careful. Some states don't accept 179 depreciation. For California, we max out. I think it's at 20 or 25,000, and we can't take any more. It adds it really. It adds it back in as an income when you do a California return. So when you see that CA, he's like, "Oh wait, there's something wrong. California's not taking that deduction." Just got to let you know that some states don't allow that one. So just kind of be careful on that one when you do take that 179 deduction. That some states don't take those deductions and they just take the normal depreciation throughout the year. But good question. Thank you.
Yeah, thank you, Jose. Thank you for clearing that up.
All
And if
right.
anyone's on Facebook, LinkedIn, YouTube, or all over social media, if anyone has any questions, feel free to drop in below. And we're here to, Mr. Jose is going to be able to answer them. And I do have another question, Jose.
Yeah.
What about when it comes to we see the importance of usually businesses or rental income? What's the importance of like record keeping when it comes to depreciation?
Yeah. So when you're doing record keeping, I always recommend we have local agents, like your broker or your real estate agent might know someone. If you have rental properties, they might have a rental agency to keep track of the records. If you're trying to do it yourself, I know it's a lot of paperwork, a lot of things to do, keep track of. I always suggest my clients to maybe have a separate bank account so you know what's going to be the income and you know exactly what's going to be the expenses. Because if you're ever audited, you show them the bank account is 100% for the rental property and it's 100% income for the rental property as well. So it's nice to have a separate bank account just for the rental properties when you collect the rents. And if you have any upgrades or expenses, paying the mortgage through that one is usually the best way to go. But yeah, it's very, very important to keep that record tracking, record keeping on that one. I know it's tedious. I know a lot of people are like, oh, it's so much work, trying to get it all up at the end of the year. But if you pace yourself every single month and just keep track of all those expenses, it shouldn't be too bad at the end of the year for that one. And I would suggest for tax professionals to give them a rental income and rental expense worksheet for next year so they can keep track of their own records on that one. But yeah, very, very important to keep track of it.
Yeah, that's a good idea. So we usually give our tax clients that paperwork, and so then when the country prepare the taxes, we have that information beforehand, and we're not calling people, calling family members, or like, hey, can you get this information for us?
Yeah.
But yeah, but thank you, Jose.
All right. Thank
Um,
you.
yeah, so everyone, please stay tuned to our social media so you can stay updated to our tax tip. We're gonna do another one tomorrow at 1:30 in Spanish. And you have anything more for us, Mr. Jose?
No, just want to make sure. Hey, I'll be at the Tax Fest, and hopefully, I
Mhm.
see everybody there. And I'll see you guys soon. Thank you, Roberto.
Yeah, the tax fest is right around the corner, and don't forget, give us a call and register now.
All right, have a festive day. Thank you.
Bye.